Quick reminder, this is educational analysis of historical data, not financial advice. Every trading course teaches support and resistance first. Most traders still use it completely wrong. They draw a dozen random lines, call everyone key, then watch price slice straight through. So let's fix that. I'll show you what these levels actually are, how to find the ones that matter, the single most powerful move they give you, the flip, and the honest truth about breakouts, where most traders get trapped. Real Bitcoin charts. No hype, no magic lines. Start with the core idea. A level is simply a price where the market has repeatedly changed its mind. Support is a floor, a price where buyers keep stepping in and pushing price back up. Resistance is a ceiling, a price where sellers keep showing up and knocking price back down. That's it. Not magic, not a prediction, just a zone where, last time price got there, one side took control. And the more times price has reacted at a level, the more the whole market is watching it. That attention is exactly what makes it matter. A level nobody remembers does nothing. A level everyone remembers becomes a place where orders stack, decisions cluster, and price is likely to react again. So before you draw a single line, ask one question. Has price actually turned here before, more than once? If the answer is no, it isn't a level yet. It's just a guess wearing a straight line. Let's make support concrete on a real Bitcoin chart. Late in 2024, after Bitcoin first tagged $100,000, 91,000 turned into a floor. Watch it happen. Price drops down to that level and bounces, pulls back weeks later, and bounces again. 4 separate times, the same floor holds. That repeated floor is support. And why does it hold so cleanly? Because everyone can see it. Buyers who missed the first bounce leave their orders right there, so when price returns, a wall of demand is waiting. Support doesn't hold by magic. It holds because the whole crowd remembers it and acts there again. Notice the word repeated. 1 bounce is an accident, 2 is a coincidence. 4 separate reactions at the same price is the market telling you exactly where buyers live. That's the difference between a level worth trading and a line worth ignoring, the number of times price has already respected it. Resistance is the mirror image. A ceiling. Here's a real one. Right through 2024, $72,000 capped Bitcoin over and over. Watch, price rallies up into that level, gets rejected and knocked back down, comes back a month later, and gets rejected again at almost the exact same price. Above it sit the sellers, profit takers and trapped buyers from higher up who just want out at break even. That stacked supply keeps slamming the door. So support and resistance are really just the market's memory of where it turned before, and reacting there again. Simple so far. But here's the part that actually makes these levels tradable, and the mistake that quietly ruins it for most people. Because knowing where the floor and ceiling sit is only half the picture. How you draw them, and what you wait for, decides whether these levels make you money or hand it straight to the traders sitting on the other side. The single biggest mistake is treating a level as an exact line. It isn't. A level is a zone, a small band, not a price to the dollar. Look what happens here. That same 91,000 support. If you drew it as one razor-thin line, watch this candle. Price wicks straight through it, down to 89, and you'd have been stopped out right at the bottom. But it was never an exact line. Draw it as a zone, and you can see the wick is still inside it, and the candle closes back up, the level holds, and price runs. Real markets overshoot and grab the stops sitting under an obvious line. That overshoot isn't random. It's deliberate hunting of the orders resting right where amateurs place them. So give your levels room. Draw the zone around the wicks and the closes, and wait for the close, not the wick. Honest levels are zones, not lines. Now, the most powerful thing support and resistance gives you, the flip, also called role reversal. Watch this real Bitcoin example. 65,000 acted as resistance. Price hit it and got rejected, again and again, a clear ceiling. Then buyers finally push through and close above it. And here's the turn. Price comes back down to that same 65,000, but now it holds as support and bounces. The old ceiling has become a new floor. That is the flip, and it is the highest probability entry these levels offer, because the retest confirms the level is real before you ever commit. Instead of guessing whether a breakout will stick, you let price come back and prove it. If the old resistance holds as support, the market has just shown you its hand. If it doesn't hold, you were never trapped, because you waited for the retest instead of chasing the first candle through. Why does a broken level flip like that? The same reason it worked in the first place: memory and trapped traders. When resistance breaks, everyone who sold there is now offside and wants out at break even. Buyers who missed the move want a second chance in. So on the retest, that old ceiling is now stacked with buyers instead of sellers, and it holds. A level that breaks and then successfully retests is one of the cleanest signals in all of trading. You get a defined entry and a stop just on the other side of the zone if you're wrong. That's the quiet beauty of it. The same crowd psychology that made the level resist now makes it support. Nothing mystical is happening. Just thousands of people reacting to the same obvious price for the same predictable reasons. Read the psychology, and the flip stops looking like magic and starts looking like arithmetic. But, and this is where most traders quietly lose money, not every break is real. Price pushes past a level, everyone screams breakout, they pile in, and it immediately snaps back and traps them. That's a fake out, and on lower time frames, the majority of breaks are exactly that. The market loves to poke just past an obvious level to grab the stops resting there, and then reverse. Think about it. The more obvious the level, the more stops sit just beyond it, and the more tempting it is for price to run there and reverse. So the real skill isn't spotting a breakout. Anyone can see a breakout after it happens. The skill is telling a real one from a trap while it's still forming. And there's one simple filter that does most of that work for you. It won't catch every fake, nothing does, but it filters out the majority of the traps that catch impatient traders. The filter is the difference between a wick and a close. Watch this. Price keeps spiking above resistance, but every single time, the candle closes back below it. Those are fake outs. A wick above the level means nothing, and the breakout buyers who chase the spike get trapped when it snaps back. The real breakout is different. A candle that closes decisively above the level and then holds. That's the one. From there, Bitcoin ran hard. So the rule is simple, and it will save you a fortune. A wick above is fake. A close above, plus a retest that holds, is real. Why does the close matter so much? Because a wick is intra-candle noise, a brief overshoot that gets rejected before the period even ends. A close is a decision the whole market agreed to hold. One is a probe. The other is commitment. Wait for the commitment, and most of the traps simply pass you by. So how do you actually trade all this? 3 honest rules. 1. Trade toward the level, not away from it. Buy near support, sell near resistance, and always into the zone, never chasing a candle that already ran. 2. Wait for confirmation. Don't buy the instant price touches a level. Wait for a reaction, a clear bounce, or on a break, a close beyond it, plus a retest that holds. 3. Always place your stop just on the far side of the zone, so when a level fails, and some always do, you're out small and it costs you nothing. Confirmation and a stop are what turn a level from a guess into a trade. Notice what these three rules have in common. Patience. You wait for price to come to you, wait for it to react, and define your risk before you commit. The level gives you the map. Discipline is what turns the map into an actual plan. And be honest about what levels can and can't do. A level is not a prediction. It's a decision point. It tells you where the odds shift and where to place your risk. It does not tell you what will happen next. Levels fail all the time, especially against a strong trend. A support sitting in a hard downtrend will eventually give way, so use them as a framework for your entries, stops, and targets, not as a crystal ball. The edge was never the line on the chart. The edge is how you manage the trade around it. Two traders can draw the exact same level and get opposite results because one waited for confirmation and used a stop, and the other chased and hoped. The chart is identical. The behavior is not. That is why professionals talk less about being right and more about how they lose when they're wrong. Get that part correct, and the levels start working for you. So, here's the whole thing in one picture. Support is a floor, resistance is a ceiling, and both are zones the market remembers. The break and retest flip is your highest probability entry. A wick is a fake, and a close is real. And confirmation plus a stop is what makes any of it an actual trade. Master those few ideas, and you're reading price the way professionals do, not with a mess of magic lines, but with a simple, honest map of where buyers and sellers are actually fighting. Everything else, the indicators, the patterns, the noise, sits on top of this foundation. Get the foundation right, and the rest becomes clearer. Get it wrong, and no indicator will save you. Fewer lines, drawn where price has actually turned, treated as zones, traded with patience and a defined stop. That's the entire discipline. Simple to describe, hard to follow, and that difficulty is exactly why it still works. That is the complete, honest guide to support, resistance, and breakouts. This is educational analysis of historical data only, not financial advice. Always do your own research and manage your risk. If this careful, numbers-first approach is how you like to learn, consider subscribing. And the next breakdown will be waiting when you are.